That $200 plane ticket you are holding represents a fraction of what the airline is actually spending to move you from one city to another. A single Boeing 737 costs an airline between $8,000 and $12,000 for every hour it is in the air. A wide-body aircraft like the 777 pushes closer to $20,000 per hour. And yet somehow the average domestic ticket sells for less than the price of a decent hotel room. The economics of commercial aviation are so extreme that the industry has collectively lost more money over its entire history than it has ever earned. Understanding why requires looking at every cost that never appears on your boarding pass. Before an airline sells a single ticket, it has already committed to one of the most expensive purchases in any industry. A brand new Boeing 737 MAX 8 costs around $120 million at list price. Airlines almost never pay list, but after negotiated discounts, they are still looking at $60 to $90 million per aircraft. A new Airbus. A 350 runs close to $300 million. A Boeing 777X approaches $450 million. Most airlines do not buy aircraft outright. They lease them through specialized aircraft financing companies called lessors. AerCap, Air Lease Corporation, and SMBC Aviation Capital collectively control thousands of aircraft worth hundreds of billions of dollars. A 737 lease runs between $300,000 and $500,000 per month. For a major carrier with 300 aircraft in service, that is a commitment approaching $150 million every single month before a single wheel leaves the ground. Aircraft also depreciate. A new narrow-body loses roughly 30 to 40% of its value in the first 5 years. Maintenance and inspection requirements increase with age, raising the cost of ownership even as the asset declines in value. The accounting burden of managing a modern fleet requires entire departments of financial engineers whose sole job is structuring aircraft deals and managing return conditions when leases expire. Jet fuel is typically the single largest expense for any commercial airline, representing 25 to 35% of total operating costs. On a typical transatlantic flight from New York to London, a Boeing 777 burns approximately 60 tons of jet fuel. That is roughly 20,000 gallons. At current jet fuel prices near $3 a gallon, a single transatlantic crossing costs around $60,000 in fuel alone. For a domestic 737 flight from Los Angeles to Chicago, the fuel bill runs between $5,000 and $9,000 depending on payload, winds, and routing. Multiply that across hundreds of daily departures and the numbers become staggering. United Airlines alone spends close to $10 billion on fuel in a typical year. Fuel prices are volatile and completely outside airline control. When crude oil spiked in 2008, jet fuel briefly reached $4 a gallon. Several carriers went bankrupt that year. Delta responded by purchasing an oil refinery in Pennsylvania to directly control its supply chain and hedge against future price spikes. Most airlines use financial derivatives to lock in fuel prices months in advance, but hedging is expensive and imperfect. A sudden swing in crude prices can turn a profitable quarter into a catastrophic loss overnight. Airlines that hedge correctly when prices rise look like geniuses, and airlines that hedge when prices fall lose money on the hedge itself on top of their operating costs. A commercial airline pilot is one of the most extensively trained professionals in any field. Reaching the right seat of a regional jet requires at least 1,500 flight hours, which in the United States typically costs the pilot between $60,000 and $100,000 in training costs. Making captain at a major airline requires 10 to 15 years of experience and thousands of additional hours of accumulated flying. Senior captains at United, Delta, and American earn between $300,000 and $500,000 per year when overtime, per diem allowances, and profit sharing are included. Regulatory requirements mean every commercial aircraft must carry at least 2 certificated pilots. Long-haul flights over 8 hours require relief crews, so some intercontinental flights carry 3 or 4 pilots who rotate through rest cycles. Flight attendants must be present at a ratio of 1 per 50 passengers. A fully crewed wide-body aircraft on a 10-hour international flight may have a crew of 12 or more people, all on the airline's payroll for that day. Beyond base salaries, airlines carry substantial costs for crew training, simulator time, and regulatory recurrency checks. Pilots require full simulator evaluations every 6 months. Type ratings authorizing pilots to fly a new aircraft type can cost $30,000 to $50,000 per pilot. For a major airline transitioning to a new fleet type, training costs across hundreds of pilots run into hundreds of millions of dollars before the first passenger boards the new aircraft. Aviation has the best safety record of any form of mass transportation, and that record is purchased at extraordinary cost. Airlines are required by regulation to maintain their aircraft to a standard that no other industry approaches. The Federal Aviation Administration and its counterparts around the world mandate inspections at every level, from pre-flight walk-around checks performed before each departure to complete structural teardowns of every component on a schedule measured in flight hours and cycles. An A-check, the lightest scheduled maintenance event, takes a few hundred maintenance hours and happens roughly every 500 flight hours. A C-check requires thousands of labor hours and removes the aircraft from service for 1 to 2 weeks. A D-check, also called a heavy maintenance visit, tears the aircraft down to bare metal. Every system is inspected, tested, or replaced. Paint is stripped. Wiring bundles are examined inch by inch. Flight control surfaces are removed and bench tested. A D-check on a 747 can take 50,000 labor hours and cost $20 to $30 million per aircraft. Airlines employ tens of thousands of maintenance technicians, engineers, and quality inspectors. They maintain vast inventories of spare parts because regulations require immediate access to critical components. A single spare engine for a 787 Dreamliner costs over $30 million. Airlines that operate efficiently keep a spare ratio of roughly 1 engine for every 10 aircraft in their fleet, representing an enormous inventory of capital sitting in warehouses waiting for a failure that may never come. Every time an aircraft departs and arrives, the airline writes checks to a cascade of third parties. Landing fees at major airports are calculated by aircraft weight. A heavy 777 landing at Heathrow pays thousands of pounds per movement. At New York JFK, landing fees for international heavy aircraft can run several $1,000s per arrival. Gate rental, ground handling, pushback services, fueling, catering, lavatory servicing, and aircraft cleaning add further layers of cost that accumulate with every turn. En route, aircraft pay navigation fees to the air traffic control authorities of every country they cross. Transatlantic routes pass through multiple oceanic control regions, each with its own fee structure. Airlines flying polar routes between North America and Asia pay navigation fees to Canadian, Alaskan, and Russian air traffic authorities. A complex international schedule across dozens of country pairs can generate tens of millions in navigation charges annually. Overhead that never shows up on the ticket price includes reservation systems, airport check-in staff, call centers, frequent flyer programs, airport lounges, corporate administration, legal departments, and insurance. Aviation insurance for a major carrier costs hundreds of millions per year. Hull insurance alone on a fleet of modern wide-body aircraft represents one of the largest property insurance programs in the world. When you add liability coverage and war risk policies, the annual insurance bill becomes a significant line item even before operations begin. Airline revenue management teams spend enormous resources optimizing every seat on every flight. They use sophisticated algorithms to price tickets dynamically, filling the plane at the highest possible average fare. A 737 carrying 160 passengers might generate average revenue of $200 per seat, a total of $32,000 for the flight. Against a direct operating cost of perhaps $15,000 to $20,000, that looks like a profit. But direct operating costs do not include aircraft ownership, interest payments on debt, overhead allocation, or the losses from flights that do not fill. Airline load factors, the percentage of seats actually occupied, average around 85% across the industry in normal times. That means roughly 1 in 7 seats flies empty. When you factor in the flights that operate below break-even load, the overhead that cannot be reduced in a downturn, and the capital required to keep the fleet current and competitive, the margin that survives all of that is razor thin. In a good year, a well-run major airline earns operating margins of 5 to 8%. Many years they earn less, and some years they lose everything. A single disruption, a fuel price spike, a pandemic, a recession, a safety grounding of a core fleet type can erase years of accumulated profit. The Boeing 737 MAX grounding in 2019 cost airlines billions of dollars in compensation, lease payments for aircraft they could not fly, and rebooking costs for affected passengers. No other industry is simultaneously so capital-intensive and so exposed to external shocks it cannot control. Given the economics, the question is not why airlines go bankrupt, but why any rational organization keeps building them. The answer is a combination of necessity, government support, and the sheer inescapability of air travel in a global economy. Commercial aviation is infrastructure in the same fundamental sense that roads and ports are infrastructure. Governments guarantee its survival through regulatory frameworks, route protections, bankruptcy reorganization laws, and in extremis direct subsidies and bailouts. For passengers, the price compression that airlines achieve through intense competition has made flying accessible to billions of people who would have been grounded a generation ago. Adjusted for inflation, airline tickets in the United States cost 60 to 70% less today than they did in the early 1980s before deregulation. The modern low-cost carrier model, pioneered by Southwest in the United States and Ryanair in Europe, demonstrated that when costs are relentlessly managed and complexity is stripped away, aviation can be made almost as cheap per mile as driving. For the investors who still commit capital to the sector despite its brutal history, the appeal is the operating leverage. When demand is strong and fuel is cheap, the high fixed cost structure of an airline turns small revenue improvements into large profit swings. When both conditions hold simultaneously, as they did briefly from 2015 through 2019, airline profits can be spectacular. The problem is that those conditions never hold indefinitely, and the catastrophic downside is always one crisis away from wiping out everything that came before it. The next time you book a flight and wince-set the price, consider what is already embedded in that number. The cost of keeping an aircraft airworthy through a regime of inspections that never stops. The salaries of the pilots who spent a decade and a fortune training to sit in that cockpit. The fuel that will burn at a rate you cannot imagine at altitude. The landing fees, navigation charges, catering, insurance, and the spare engines sitting in hangars waiting for the call. Aviation is the most technically demanding commercial enterprise ever scaled to mass market, and the miracle is not that tickets are expensive. It is that any seat ever sells for as little as it does.